Today, I'm talking to a guy who's been inside this game longer than a lot of traders have been alive, and he's still obsessing how to read the market better. My guest is Tim Ord, a former math major, an old school stockbroker from the late 70s and 80s, and one of the true OG technical analysis guys. While everyone around him was worshiping fundamentals, Tim was the rogue in the corner, hand-drawing charts, tracking price and volume by pencil, and building trading ideas off behaviors, not stories. This is a guy who survived the 87 crash as a stockbroker, built a facts-based market letter before the internet was even a thing, and created his own secret science of price and volume. And he's been timing panic bottoms and major turns in the S&P and gold miners for decades, using tools most traders barely ever glance at: the tick, the tring, and raw price volume. In this conversation, you're going to hear how he made the leap from prison counselor to broker to full-time technician, how he used panic indicators to step in when everyone else was running for the exits, and the brutal losses that forced him to tighten up his rules. And he's going to mention his big picture that he reads right now on stocks, gold, commodities, and inflation. And if you ever wondered how some traders seem to feel when a low is real and when it's just another trap, and how to read an indicator like the tring and the tick without your eyes glazing over, this episode is going to open up a whole new side of technical analysis for you. I'm here with Tim Ord. And Tim, thank you so much for being here. I really appreciate it. Please tell me and the viewers how you got into the markets, how you got into trading.
Well, actually, I'm was a math major back in college and stuff, and I'm in technical analysis. In other words, I don't really look at fundamentals really, but technically it matches my brain waves, I guess you might say. So it really interests me to do a technical analysis. I was a stockbroker back in 1977 until 89. So
what
I was
firm?
around Dean Witter. Matter of
Okay.
fact, there were the big three, or it was E.F. Hutton, Dean Witter, Merrill Lynch were the big three back then, and I was with Dean Witter. And so I was with them several years, and technical analysis back in the 70s and 80s wasn't really the big firms didn't look at that as a viable solution to picking stocks. They were thought fundamentals is the only way to do it. And I was kind of a rogue guy, I guess you might say. I was following Joe Granville. You have to be pretty old.
Yes, I remember Joe Granville, yes.
And Stan Weinstein. They were kind of the pioneers of technical analysis per se. There was others, but those are the two ones I kind of was drawn to. And so I kind of didn't learn. They were pretty rudimentary back then.
Were you doing charting by hand, like point and figure?
Yeah,
X's
charting
and
by
O's?
hand. Yeah, you could buy, little square chart papers and stuff. And I was kind of doing that, and kind of a hard, slow process of learning how to do technical analysis. But that's pretty much how I started. Then books started coming out in the worthwhile books on technical analysis started coming up, late 90s, early 2000s. And a lot of those weren't very good. They kind of led me the wrong way, really. And you had to kind of relearn things as you went. But now technical analysis is all over the place. So it's easy to get a hold of. But anyhow, getting back to mathematics, that was kind of and being in the brokerage business kind of led me to a technical analysis. And from there, I kind of started my own business in 1989 called the Ord Oracle, and it's all strictly price and volume relationships and stuff like that. So it's anyhow, I've been doing that for 40 years or close to
Wow.
it. So
Wow. I'm just curious how did you wind up at the stock brokerage firm, even in the very beginning? I know I'm going backwards a little, but I'm curious.
Yeah, I graduated in 73. I was a counselor at a prison because back then there wasn't really any jobs. So economy was slow. So I took whatever I could get. And one of my friends became a stockbroker. And I didn't even know what a stockbroker was. Are we talking cows here or something? And it's just, no, it's just, I I go to the office and I trade for people. What do you trade? It's I trade stocks. I'm thinking, like gold stocks, IBM, and that's what I did. It's just, that sounds interesting. So I kind of talked to them about it, and we kind of went back and forth. I think, God, this is really interesting me. So that's how I got into it. I started to apply to firms. And back then, there was a huge screening process you went to get hired by a brokerage firm.
Sales tests. See if you're a good salesman, because that's what I had to experience that in the early 90s.
Oh, really?
I applied to Smith Barney, and I was all excited with my brand new suit showing up, and they put me in a room with 40 other people taking a test.
Yeah. Well, back
needless
then,
to say, I did not get a call back from that particular interview.
But yeah, they sent FBI reports and everything to check your background.
Oh yeah.
Back then, because they were strictly to get into that profession. They were did a lot of background checks, took a bunch of tests, took tests for like 3 months, and actually we had 360. I don't know. I forgot 360. Let's call it, say 350. Of the 350 applied.
Wow.
Applied for that job. 61 made it through that process, the screening process. Now one of the 61. Then we went to San Francisco 6 months, and they trained you all on their products and stuff like that. So it was really an in-depth situation. So, but all in all, basically you're a glorified salesman when you.
Yeah, absolutely. You were dialing for dollars.
Yeah, dialing for dollars.
It was when I started in the 90s, it was the same thing. And it was a little easier, though. The market was hot it was a little slow when I started, but then it picked up in the mid 90s, and people wanted your phone call. You could actually make a cold call and you'd get someone within 20 minutes, so at least you could have a conversation with. I couldn't imagine doing that today. It's just, with the robocalls, there was no call waiting or caller ID back then. You didn't know who was calling. Remember the old days? We used to run to the telephone when it rang. Now we hear it ring and we just repulsed. It's kind of a funny era. So, okay. So you were a stockbroker until 89.
Mm-hmm.
So there was a crash of 87. You lived through that.
Yeah.
What was that like for you?
I was kind of transitioning out of it. Actually, I switched out of Dean Witter, went to another company called E.J. Pittock out of Denver, Colorado, and I became an option principal and vice president of the firm. And I started. Options were very new back in the early 80s. And they had puts and calls. First came out calls, kind of then after about 6 months a year, they put puts on because they thought it was too complicated. And I was vice president when I created a call-in service to the brokers, and I call it Timely Tips. And I put my tip on I put it into
Did you guys have the
answering machine? Because we don't have answering machines anymore.
So people would dial into the answering machine.
And I'd put my message on that answering machine, what I thought the market's going to do and stuff like that. It was free for the brokers in our firm and stuff. And,
one call at a time.
One call, about a 2-minute message, because that's the length of the call you could do. And so it was busy. They had to wait until that 2 minutes somebody called in. And it worked out pretty well, but that's why I started diving into technical analysis back in basically the early to mid 80s.
Did you guys have a hoot and holler or a squawk box, as they call it?
No, we didn't have that. It just we had this phone system that I kind of created, and so I was kind of leaning way towards technical analysis, and I was more interested in that than customer service. I guess you might say.
Me too. That's what happened to me as a broker too. I wanted to do analysis. I wanted to trade. I didn't want to be psychologist for clients, because you wind up being psychologist over time.
You get on a phone conversation with somebody, you'll be on there like hour and a half. You get maybe an order out of it. But yeah, it's people call in, they're like, he became friends with them, and it was kind of like chit chat for an hour.
Yeah. Well, we were gatekeepers of a stock's price. So if a customer wanted to know the price of some of the stocks he owned, he had to call you. So you had to take those calls. There was no online. There was no internet. There was no checking your stocks online. There was no cell phones. It was really. It's so funny because I just don't see myself as being that old, but. I mean, I'm sure you remember, say if a customer wanted to buy a stock, you had to write it on a ticket.
Yeah.
We used to run it over. If you don't know, I was a stockbroker also for 17 years. I started in the 90s. And we used to run it over to an order desk, and it got wired up to take 3 to 5 minutes to get an execution. The market could be like a point, 2 points away from where you thought it was. It was always a bad execution too, always.
Yeah, I remember that. I had to stack and write it out. It was something, especially if you got the wrong order. And I did pretty good. I always check my orders, but we had one guy in the office putting in it was a big trade. Anyhow, in a nutshell, this was the order, but he put it in the wrong order and it cost the company $250,000.
Oh, wow. Which was a fortune back then.
That was a fortune back then.
Did he keep his job?
He put in a virus. I forget what. I was wrong direction, and it was a mess. So
did he keep his job?
No, he kept the shop, or he kept his job. He was actually a big producer.
Yeah,
but he wanted to cover it for him, and I don't know. Maybe they did make an arrangement for the commission. I don't know, but he stayed. So, but
he's lucky.
So that's really scary.
Big producers, yeah. Okay, technical analysis. So. Was there, when you got into technical analysis, did you have a mentor? Was there some system you were following? I know point and figure was what I learned. My dad was a commodities futures trader. He taught me how to do point and figure charts when I was about 15 years old. And so the only other person I saw doing point and figure back then were guys on the floor of the New York Mercantile Exchange and also Dorsey Wright. I don't know if that name rings a bell.
I did a webinar, or not a webinar. I did a seminar with them back in maybe mid 90s, 2000. Yeah, he wrote the book Point and Figure. I think I forget. But yeah, I met him.
So you were using X's and O's, and did you have a mentor?
No, actually, I did do X's and O's. I was kind of more into price and volume. Prechter kind of falls down. Robert Prechter, who was kind of big in the day. He lives in Florida somewhere. I remember him at all. Robert
I do not.
Prechter. He's kind of the Elliott Wave guy.
Okay.
I tried that, which Elliott Wave to me doesn't work, but it was a big seller back in the day. Then I started getting over price and volume, Weisskopf method.
Okay. I've heard of that.
Yeah, that kind of got me more on the price and volume analysis. I did write a book called The Secret Science of Price and Volume. It's on
I saw that on Amazon.
Yeah, Amazon. And that's kind of an offshoot added to the Weisskopf method, my take, because I find out Weisskopf had a lot of good ideas, but some didn't work as good as others. And so I kind of expanded on it. So I guess if I had I kind of just stumbled along at the beginning because, our age, we didn't really have, people really knew, you took bits and pieces of things that seemed to work and try to put them together. And so I didn't really have somebody teach me how to do things, but the Weisskopf method was a point in the right direction. They had stock trends. Evers McGee stock trend was written in the 1940s.
Wow. Okay. I'm not familiar with that one. I'll have to check that one out.
Yeah.
Was it helpful? I mean, were there real patterns there that had correlation that worked?
Well, they did all the triangles and the rising wedges, falling wedges. That was Evers and McGee's stuff. And they talked a little bit about volume on but they were there all the pattern stuff back in the 40s.
Wow.
And that was, I pretty much memorized that book, but it was really somewhat vague compared to what they have now. But and that was, they were passed away because the books I got were 1940s. I don't know when they passed away, but I read, they only had one book, and I still actually have the book. And so I studied that. I started off trading commodities with it, which didn't work out well. But so, you find your way, So
yeah, absolutely. Sometimes
going.
you got to get hit over the head before you kind of figure it out.
Yeah.
So you went to this independent brokerage firm, and you started with your own version of a call-in line to get the daily recommendations. And then I guess at some point you decided to start this newsletter.
Right. Yeah.
What gave you the confidence that you had something to offer?
Actually, some of the brokers' clients started calling in, and those clients started talking to me. And said, if you started, it's just a very small circle but I had probably about maybe 10 or 15 of those people, of those 10 or 15 actually turned into clients of mine at the beginning. So I had, 10, and I kind of gave 10 freebies. And so I got a little bit of income coming in off of that. I think I was charging $40 a month, $35. I can't remember exactly what it was, but it was some fee coming in. And then the internet was just starting kind of to pop up. And I was invited to Las Vegas to talk. I was doing kind of a tick method, NYSE tick and trend. I had a kind of a method. I actually still use that method to identify climax bottoms and stuff like that. Anyhow, I got invited to speak at a conference out in Vegas, and that helped a lot. That kind of, because I had now an audience of, I was giving 2 or maybe 3, about an hour and a half kind of seminars, and they'd come in. I'd have about 100 people in a room, and I did it for 2 days, so that was in front of about 600 people or whatever.
Okay.
And those turned it, and I got about 1% of those, about 30 or 40 people out of that, and that was almost enough to get things going, just from that one deal. And so from there, it kind of word of mouth, and I was also, the Chicago Board of Trade took my market letter, and they posted on the, somewhere on the floor, I guess, back in the 90s. Okay. Yeah, that helped. So it just kind of word of mouth. You didn't really have, but that seminar in Las Vegas to help, and I started doing that. In the 90s, it was kind of big. Now,
so how did you distribute it with no internet?
Fax. Fax.
Fax. Yes. Yeah, and it always amazes me that doctors today are still using this fax technology.
That's right.
It's absolutely unbelievable.
Yeah, I did a phone number. I found a program somewhere that just scrolled through the phone numbers to fax this market letter.
Okay.
So it was slow and tedious. I mean, my phone bill was gigantic because it was, it cost back then, and it's, I don't know, it was $600-700 a month. The fax machine, but it was worth it now. So then the internet came along, and then that was kind of a slow process because people are still used to fax. People are slow to move to internet because the internet was booty back then. But if you find a way, you just kept going. So,
gotcha. So I noticed on your newsletter, I looked at a couple samples of your newsletter. It looks like you pretty much stick to the S&P and to gold and a little bit to NASDAQ?
Not so much. It's just, I kind of just narrowed it down. You could spread out so far on this.
Oh, yeah.
Newsletter, and you get lost in the weeds. And so I try to just stick with 2 things. And over the years, I used to have NASDAQ kind of drop that with the S&Ps, because S&Ps go up, NASDAQ goes up. So there's kind of a parallel there. But
Right.
if you get, well, you know, I kind of got scattered a little bit in the 90s, and I was, you know, perfect for some people, but way off subject for other people. So you got to pick a subject to stay with. And
Right,
so I just
right.
kind of stuck with peas and gold. And gold right now is hot, and S&Ps has been good. You know,
Well, let's
maybe
talk about that for a second. I mean, I have some interesting other questions, but I think a lot of people would be asking. You know, gold has had this unbelievable run from its breakout. Hit what, like almost 4,500 or so. Pull back to just under 4,000. Looks like it's trying to move up again. What are your charts telling you?
well, I do the gold stock per se, GDX, and
Okay, the miners.
the miners, and that's people are more interested in the miners than they are gold. Anyway,
Do they move
pay
faster than gold?
attention. Yeah, they move a lot faster than gold. So
Okay.
that's the reason why I think the public's more interested in gold, which gold stocks. So that's the reason why I put it in GDX, not really gold, because they're more interested in
Okay.
stock than the gold. But anyhow,
What's your feeling on it?
Well, there's a 12-year cycle of the XAU to index, XAU to the NASDAQ. There's a ratio, and you do a monthly ratio of that, and you do an RSI of that ratio. And so when this ratio is moving up, XAU to QQQ or NDX, then the gold stocks are outperforming NASDAQ. When the ratio is going down, the NASDAQ's outperforming the gold stocks. So there's a method called initiation of an uptrend. It really works. I kind of learned it over the years. When something unusually pops out of the blue and goes to the stratosphere, that's usually, especially when it's gone really nowhere for the last few years, it's gone up and down. But that ratio has broke out, the RSI has broke out above 50. The last time that happened was 2000.
Okay.
And when before that, it was like 1980 or something. I have to go back and look. But anyhow, when that RSI jumps way above, we'll get up to like 70 or so. And that's the first time that has happened since 2000. And we call it initiation of an uptrend. And usually when that happens, the character of the market has changed.
And we hit that recently.
Yeah, and we hit that basically, and it started in 2024, but that trigger came in this year. I think it was August of this year. So even though the market's been rallying since 2024, yeah, that was the bottom and rallied. But then to initiate that signal on a monthly time frame took August of this year. So it's probably, it doesn't try to catch the bottom or the top, but it does try to catch the 80% of the middle part of it.
Okay.
And that's it. Just the next 12 years, gold market is up. So 12-year cycle. So they're big cycles.
So you think that it's hit its peak for the 12-year cycle, or
no? It just started.
Oh, it just started. Okay.
It just started.
Even though when it hit 70, it was overbought.
Right, it's overbought, but that's the initiation of an uptrend. So once you break above 50, usually hits 50 over the last 12 years and turns back down.
Okay.
This is the first time it got above 50, hit 70. So it's overbought right now.
When can you potentially? Oh, it's still over 70.
No, it's not now. It's starting to back off around 57 right now. But,
so where would you buy it?
Well, we're probably in a trading range right now. GDX is 84. You got resistance. You got 70 area. We're probably going to flip sideways here for a little bit.
Okay.
But the sideways move is just consolidate to pull more up later. And the only place you can really find penny stocks, which was big back in the 80s, 70s, and 80s, they were big.
Yep.
And actually
in the late 90s, but yes.
Right. Okay. It's pretty much the only place you can find penny stocks in the gold market right now.
Right.
And so if you do, you know what Bollinger Band is? I'm sure you do.
Yes, of course. Bollinger Band.
John Bollinger Band, right? He came up, but anyhow, if you do a monthly Bollinger Band on one of those penny stocks right now, what you'll find is the Bollinger Band, the mid-Bollinger Band is starting to, monthly, not the weekly or the daily, but the monthly is starting to bend up. And you also notice a big volume surge. I mean, 400% on average, big volume compared to the previous months and years before are all going into these little penny stocks.
Yeah,
and the
I know what that message is. What's that message for you?
These little penny stocks, a lot of them that are doing this pattern are starting a major uptrend because volume's gone in on it and momentum's turned up.
That's exactly what happened with the bulletin board and the pink sheet stocks in the late 90s before it popped. And that's historically, at least from what I know, what happens at the end of a cycle is you find the smallest cap, many case garbage related stocks will make a move as the money is trickling out of the big cap, the mid cap, the small cap into the into anything that can be somehow manipulated or just from pure supply and demand. I mean, they become like meme stocks, I guess is the best modern term to describe how some of these small caps get revived from the dead, basically shell companies many times.
Yeah, a lot of those are doing that. So I think the equity market, the big, are going to take a rest here. And I think, so if you look at all the commodities too, there's bullish patterns on USO, which is basically a oil type situation, and GSG, which is a commodity, which is the grains and the metals and the food stocks, whatever. All of those are starting to show bullish patterns. So I'm thinking the equity market is going to slow down, and on these commodity markets, you're going to speed up. Is what I'm starting to think. So this inflation thing, I think we're going to have more of it. So
I can just tell you a couple things. This is just like anecdotal when you talk about inflation. So I build computers for traders, like see behind me, and just in the last 3 weeks, the price of memory chips has gone up 75%. I haven't passed it down to the customer yet, but RAM, essentially, random access memory, has gone up 75%. And I mean, we've had talk about inflation for quite some time now. And this is the first time, I mean, the pandemic, when there was supply issues, there was some inflation, but it definitely leveled off, and actually prices of components came down a bit. But now I'm really, really seeing it. And that's just people will argue RAM chips are a commodity when it comes to electronics. We all go to the food market and see how much food costs. And it's just slightly unrelated, but I mean, they talk about the cost of living maybe went up 3 or 4%. I mean, if you're a homeowner and you own a car, if you factor in your homeowner's insurance and your car insurance and then your health insurance, your expenses probably went up 10% or more in the last 12 to 24 months. So, I think these things kind of feed in. And then lastly, I'll just bring up these hundreds of billions of dollars that are being spent, that are going to be spent on this AI data center build out. I mean, so we talk about unemployment, but somebody's got to build these data centers, and people have to be trained to build these data centers. That's a lot of money coming into our economy. That's going to create pockets of inflation somewhere. What's your thought on that?
The precious, those chips are basically precious metals. And if you look at any precious metals over the last year, I mean, a lot of them have broke out and really gone up. Uranium, and I don't pay attention to a lot of them, but the chips are expensive because the metals that go into them.
Yeah, copper, silver, gold. Mm-hmm.
Yeah, all that. So, and I don't see
platinum
ending. Platinum. I don't see that ending anytime soon. They're trying to open up, mines back here in the United States. Over the last several years, politically, they took all the mining operations more or less out because of climate situations. You dig a hole and it creates dust or something. I don't know. So a lot of those mining companies are reopening in the United States, which may alleviate some of the price surges. But it'll be interesting. I think these metals, whatever metal it is, copper to gold, are all going to keep going up here. So I was thinking we're into a 12-year cycle to the upside. So
wow,
things could get more expensive than what they are right now. So
you talked about
times.
Yeah, for sure. And you just talked about how your gold to the NDX ratio. So I'm curious, what is your that's your strategy for gold, for trading the GDX? You said for trading the miners.
No, that's the huge picture.
Oh, that's the big picture. Okay.
Yeah, it's a big picture. And you go down. I do price and volume on GDX type things, and like I said, we did have a surge up here at about 84, 85. And if you do a monthly Bollinger Band on that GDX, if you get above the outer Bollinger Band, they got a top one and a bottom one, and they got the middle one. And if you get 100% outside of the upper Bollinger Band, that market stretched too far. Right. A lot of times you come back, and that's what we had back here. And I think it was June or July. I have to go back and look right now. So I don't have a chart in front of me.
So it sounds like you took a couple of different indicators and created your own strategy.
Yeah, I did. I read a lot of different books, and I took what made sense to me and seemed to work. And so I don't really, I create a lot. I do a lot of stuff with the ticks and trend. Here's an analysis. A lot of people, markets only panic at one area, and that's at bottoms. They never peak at tops, or they don't panic at tops. They don't panic at sideways consolidation.
My dad always said that markets don't crash from the top.
Right. But so you got to find what panic is. And so over the years, I really good at, I'm pretty good at picking bottoms. Nothing's perfect, but normally I can then define how I bought them. Excuse me. And the one way you can is with the trend. The trend is the TRIN, is the indicator. Richard Arms, remember him? Sometimes they call it the Arms Index.
Okay.
But anyhow, and it got named trend, TRIN. Forgot what it stands for.
And by the way, you can pull that number up on just about every platform.
Yeah.
Yeah. Tell us what it is, because I don't think a lot of people know about it.
Yeah. Trend is it's up volume divided by, advancing issues divided by declining issues divided by up volume divided by down volume. So you do all that stuff and you come out with a number. And Richard Arms got this in the 70s. I think it was 73, because I got his book and I kind of read it and studied it. And so anyway, when it's one, then that's equilibrium in the market. It didn't really say a lot. The market's kind of neutral. But when everybody starts hitting when down volume starts to increase and down stocks start to increase, that number goes up. And that's what you want to have. As that number goes higher, that shows there's more panic. There's more volume hitting the down stocks. And so when you get up around 1.5, 2, or 3 or something like that, I've seen it as high as 10 back in
08, 20, or
yeah,
1987.
I forgot it was. Yeah, it hit 10. I mean, it was just totally everything. That was the bottom. And so you get a trend reading over the years. If you get 2-day trend readings that up to 5, that's the bottom. So that kind
2-day trend readings that add up to 5 is the bottom. You heard it here first.
Yeah. One day might be 1.5. The next day is 3.5. Add up to 5. Period. It might be 6 or 7.
Okay. Quick question. What number did you see during the meltdown of 2020 when COVID first hit? We saw that 35% dump in like 6 weeks.
Yeah. I do a 10-day trend.
Was it over 5 over 2 days?
Oh yeah, it was way up there, 7. So, and it was just nosediving. So that's when you step in, because once it goes the other way, which COVID went straight down, straight up,
right?
And and
which
so
no
once
one
it goes,
expected to go and then rally and make new highs. Took big cojones, as they say.
right, I was picking at those lows in there, and it's because you're feeling you're almost throwing money out the window.
Yeah, it feels like it.
Yeah, it feels like there's no hope this stuff is going to come back. And when it turns, it just rockets off. But that's it. You got to find panic. If you don't have panic, the market will go down until it does find panic. So if the market's going down, it doesn't look so bad, what you don't want to buy. When it does look really bad, according to the trend, that's when you want to buy.
Okay, so here's a question for you. So, like, you get a little rollover. So we're November 19th, 2025. The current narrative is the AI stocks are overheated. We've had some of these names roll over. I don't think the Nasdaq's been down 10% from the high. It's not that far off though. But some of the bigger names have like Nvidia's come down I think down to like almost 15% from the high with earnings out today, as a matter of fact. But at what point do you say, like, it doesn't feel like it's time to look for that panic indicator, does it?
It's actually, we got a signal on Friday. The trend closed at 1.2 and you got 360 downtick readings. That predicts that's panic. And they normally panic. And they get panic usually the same day as the low to as late as 2 days later, which would be yesterday. So King Friday. So we're actually bullish right now. And the market's up a quarter, but we're down like 1% yesterday, and we're Friday, we're down a little bit. Or Monday and Tuesday we're down, but I'm long. I think we're going to rally into the year end, so we'll see.
Interesting. So, which brings me to the question. Tell me about your newsletter. How often do you put out the newsletter? And you're specifically, like we said earlier, you're doing S&P and
GDX.
The GDX. How often do you put it out?
4 days a week, Monday through Thursday.
Oh, okay.
Something. Yeah, it's pretty in depth. If a signal comes on Friday, which a lot of them do, a lot of times these signals come on Friday, they make you sweat over the weekend if you're right or wrong type thing. But actually, I get a lot of readings on Friday, but I'll put out an email before the close. I'm buying, I'm holding my long position, or I'm selling my long position, or whatever. And if there's no changes, I don't do anything. But it's a 3-page report, Monday through Thursday. So
okay, and where can people find it? Where can people find you and find your newsletter?
My name is Tim Ord. You can Google me. I'm there, but my company's name is the Ord Oracle. My website is www.ord-oracle.com. And ord-oracle.com. Got it. So, and it got examples on my website, previous reports.
Okay. Now, are you trading the Qs? Are you trading the S&P futures?
No, I'm actually doing SPX.
SPX futures.
Yeah, just I take the closing price. So if I get a signal, whatever that close is that day, I don't do it intraday. It just, on the close, this is my price. So I'm not a day trader or anything, so I try to catch the trend per se. So most of the trades per year, I'm usually about 8 trades a year. So I'm not like less than 1 a month. So
oh wow, okay. So you're more of a swing trader.
Yeah, swing trader. I'm not trying to day trade or anything like that.
Are you doing anything with options?
Back in the day, I did, but I just quit. It's too messy. It's
too many variables between the time decay and
Craig. He almost have to
update
those things.
Yeah.
It's. I was doing it for a while, and it was just to keep up on it and to get the communication to the customers was so paramount. It was especially doing it. I was doing it through a fax machine. Then I was doing it through email, and it was just, you couldn't do a good job because when you needed to get out and the time you get all of that information to them, that was like 2-3 hours later, and that was sometimes too late. So I quit that and just do, I still do options once in a while, but not a lot. So
what has been the hardest thing for you to learn about trading and about your methodology?
kind of a discipline, when you need to take those trades. Before I was, sweating bullets, whatever. Then over time, you kind of get used to that. And, because it's more, the learning process, finding out what works was kind of a long process, but it wasn't hard. It was just, it's needed, you needed time to find out what not to do. Then
That's a great way to put it. That's a great way to put it. Get bumped over the head a few times.
Yeah, you get bumped over the head a few times, and okay, I shouldn't do that. And that process was painful financially, but it wasn't emotionally. To get the emotional part was hard. When I just talked about the panic stuff, when you're stepping in front of a freight train, you feel like those are the best trades to do, because panic again only forms the bottom. So you got to wait for that panic to form. Then sometimes you're a little bit early, sometimes you're a little bit late, but you're always close to the lows.
That's the hardest. It's got to be the hardest. Hardest approach. I'm a breakout trader, so I don't do that. Okay. But I do remember, obviously 2001 and how that felt, having 500 clients that I had built over the 90s. And I remember 2008, where it felt like the end of the world was near, and that feeling of this just doesn't make sense when the Dow dropped like under 7,000 into the sixes, just shaking my head saying, how is this even possible? That feeling. And then again, in 2000, how fast it happened. It was just like, you were like a deer in the headlights. And so at least for me, it would not feel natural to actually do the opposite of what's happening in that moment. That takes incredible guts to do.
Yeah, let's read why some methods work for some people and some methods don't work. It takes whatever fits your personality. But now I'm pretty comfortable. Nothing bad about it. Go back to panic situations. So you're buying yourself into a panic situation. Only thing can really go wrong, it gets more panic. So that's the problem with that. Right. So what that saying is, so you get minor panic, you're looking at minor low, or still panic, but still low, but it's a minor low. Major panic, like 1987 type things, everything just blows apart. And so you're picking out panic. The trouble is panic's going to go into a super major low that's multi-year rally. So, which is, the COVID low was it. So, I got better. 87 low, I did okay.
25% in one day, which now in theory can happen because we have circuit breakers, which we barely ever trigger. I only remember a handful of times we've triggered them. But
COVID, I think then they shut the market down.
Yeah. Was it 3 days in a row?
I can't, maybe an hour or something. They
right. So the 87 one, I was in my first semester of college. I had worked that summer on the floor of the New York Mercantile Exchange. I just turned 18.
87?
Yeah, 87. I was working on the Merc this summer, but then I started my first semester of college. So it didn't really affect me. I remember my cousin telling me how my uncle lost like a lot of money because he was all margined out. But when you look at the size of that one day, that 25%, it's just mind-boggling. Like that would take the Dow down to 38,000 today or whatever the number. Like it would be people would not be able to process a correction like that.
Yeah, it's.
And we made a new high in less than a year, I think, or within 18 months, we were back at the highs.
Yeah, that thing went straight down, straight back up. Yeah, like COVID, straight down to straight. no test, no nothing. It was gone. So
kind of, I mean, even recently, like the big beautiful bill, what do they call that day? The silly day.
Was, April.
Yeah, I mean that correction was very V-shaped also.
Yeah, straight down and straight back up again.
So here's a tough question for you. What's the biggest loss you've ever had?
Probably actually the gold market. I was still, because when that thing was flying, it was flying. And when it turns ugly, it turns ugly. And so it was in the gold market. I didn't, markets have a way to keep you in, or whatever. It just bottomed or everybody's out. Can't be able to say, I'm buying, they hate you. And when it's going up, this is what I'm selling. The public hates you for that because they're in. And so I was part of that crowd that gold market was going up, and if you sell, I'm going to hate you type. Because I have clients be able to, what do you want to sell? This thing's going to double from here. So, and I stayed in, and it split my portfolio in half. So,
and we're talking what year roughly?
That was 2000. I think it was 10 or 11 or something. That was a big learning curve.
Oh, yikes.
So it's the Apple reason, but that was something. It was a learning curve that I put parameters on that something like that won't happen again. And that was actually a seasoned trader at the time too. But I got emotionally involved, and so I don't know. It was kind of I should have learned that back in the 90s. I didn't. So. But you're going to learn everything.
Isn't that such an interesting thing about human nature? I mean, I'm involved with Wall Street now over 38 years, and sometimes I still make those emotional mistakes, even to this day. Even when I know better, it's like we're not robots. No matter how hard we try to be, we are emotional beings, and we still subconsciously get caught in the greed and the fear and easily influenced by others. Wouldn't you agree?
Yeah, it's just like sheep going over a cliff. So it's you try to not to be the sheep, but it is what it is. So, but
what keeps you inspired to keep doing what you're doing? Your newsletter.
I don't know. I guess still trying to find. Put it this way, I got 90% of my toolbox of technical analysis, and I'm always looking to add that extra 10% to it, I guess, and stuff. So I do a lot of type of research. I do repeated stuff on analysis of stocks and stuff like that. But I'm always looking for something to add on to the confirmation, I guess you might say. And that interests me because I'm a math major. That's how my mind works. And so I'm not going to walk away from that, I guess. And so I'll keep searching,
That's a beautiful thing about the markets, at least for me personally, is just that endless challenge to optimize. And I just never get bored. It's incredible.
Yeah. I don't either. It's either you're into it or you're not. Sometimes my clients call and Tim says, you're making my eyes roll back in my head because when I talk to them, because like you and I are talking, and some people can't do the technical analysis stuff. They just turn that off.
Yeah. Or even fundamental analysis. I mean, it's very boring. And to me, I never find a correlation ever. And when I can look at a chart, I've just been looking at charts for so many years that I can tell in a nanosecond, I can have an opinion, like boom. It's just like, the 10,000 hours is Malcolm Gladwell, just like, and also having the experience and getting bonked over the head a few times and learning what not to do. But yeah, it's definitely not for everybody. I just want to encourage everybody watching today to definitely check out Tim's website and possibly his newsletter. He's got some samples. If you go to his site, ord-oracle.com,
Hyphen.
Ord-hyphen,
Right.
Ord-Oracle.
Right.
Oh, okay. Let's not confuse that. Ord-oracle.com. He's got some samples up there, really great stuff. And as you've heard today, he's been at this a very long time, and he's a real guy. He's been bonked over the head. When I do these interviews, Tim, I ask everybody if they've been bonked over the head. And, sometimes some of my guests have not really experienced pain, and then I don't post their podcast because I just know they're just not being authentic. But you definitely have been there. So I just wanted to thank you for coming on this podcast today. Interesting stuff. Everybody, please go check out Tim's site, check out his newsletter. Tim, I really appreciate it today. Thanks for coming.
Thank you.
All right.
Loved it.